throughout my real estate career. A lot of this material I'm also going to be presenting today from some of my mentors who have helped me mentally develop. People like Les Brown, Jim Rome, Jay Shetty, Anthony Robbins. One of the things that we need to talk about first, and I will talk about it first before we actually get into real estate and real estate investment, is our mindset. Where are we? These are some of the people I've just mentioned who have helped me mentally. My question to you is, who's speaking in your head? Who are you listening to? Before we get into real estate again, mindset. That's the first place we need to begin. I'm going to do a thought-provoking activity right now with you guys for a few minutes before I get into real estate investment. A couple of questions that I have for you guys, and I want you to please think about it, and we will certainly speak about it after. Are you spending time with people with accomplishments? Are you picking up financial plans from unsuccessful people? Do you know that you don't have to be wealthy in order to have a financial plan? You need to recognize that you need to be smart enough to know that you don't have a plan or have the wrong plan. I need you guys to, be around successful people with a better plan and make it your plan. My other question to you is, where is your favorite restaurant? Think about it for 1 minute.
Pardon me, Sunil. I'm so sorry to interrupt you guys. Please keep your screens muted. It's throwing feedback and it's going to mess up the recording. So stay muted unless you have a question. Put it in the chat. That's all I want to say. Sorry about Sunil. Continue. Apologies.
No problem. Thank you. Where's your favorite restaurant? Please think about it, because my next question is, where do you go for your intellectual feast? What's your favorite place to feed your mind? Where do you go? What books have you read lately? I'd like to throw out a few suggestions. If you are going to be investing, you need to know some of these. You need to read some of these books. You need to be better at your game. Few suggestions. Superhuman by Joe Dispenza. You want to write these down? I'll give you about 6 or 7 of them. The Magic of Math by Arthur Benjamin. The Checklist Manifesto by Atul Gawande. Collaborative Intelligence by Angie MacArthur and Donna Makova. A small book that everyone should have read the minute you came into real estate, Who Moved My Cheese? It's a 20-minute read by Spencer Johnson. And a book that, if you want to be wealthy, The Richest Man in Babylon, George Clason. If you guys are too busy, which we all are, to sit and actually read, try listening to audiobooks. MentorBox is a good place to get some of those audiobooks. Remember, associate with people of substance. Behavior is influenced by ideas. Ideas are influenced by education, and education is influenced by the people we associate with. So be specific who you associate with. A lot of us, we gotta really think about this. Number one, don't join an easy crowd. Go where the demands are high, expectations are high. The spotlight is on you to grow, to produce, to become more than you currently are. This should be a practice, whether it's real estate or anything else in your lives. You have the ability to check and measure growth or have someone monitor your progress. Do you guys have written goals? What are some of your goals? And please take a minute and think about what I'm saying. List your goals. Do you have health goals, investment goals, travel goals, family goals? What are some of your goals? What would you like to become? Would you like to become a sophisticated person of power, Would you like to be debt-free? What mark would you like to make when you leave this earth? Talk to 2 or 3 people that respect you and get their perspective on you. Become a person of skillful language, positive attitude, be well-read, well-disciplined, person of culture and intelligence. You'll be uniquely rewarded. Remember, to attract valuable people, you yourself must be valuable. You must be attractive. You know who you are when people aren't watching you. When you are alone at home, what do? Do you spend time reading books? Or are you watching Netflix? What are you doing? Where are you? Look at a person who's been, wherever you are in life right now, look at a person who's been there for the last 20 years. Ask yourself, is that who you want to be? If that's not who you want to be, then you need to create your own path. Let's talk a little bit about time. If you got up every day and you know you had $86,400 when you woke up, at the end of the day, that money goes away. How would you invest that time? How would you spend it? What does $86,400 represent? $86,400 represents every second of the day. Where I'm headed with that is you'll never waste it when it comes to money. Why waste it when it comes to time? You could always make more dollars, but you cannot make more time. Choose people around you wisely. As a human, we love to compare ourselves with others. There's always someone in the room with a bigger house. We want that. Bigger boat or boat, we want that. Someone with a bigger bank account, guess what? We want that. Comparison breeds competition and makes your time miss out on collaboration, like today, like this moment in time, 2 different companies collaborating. Remember, competition isn't other people. Competition is your procrastination. Who do you compete with? The only thing you should compare yourself with is the person you were yesterday. I hope that lights a little bit of fire inside of you, just makes you a little bit better. Let's get into investor now. As an investor, what is an investor? Is that just a person who buys a 2-family, flips a 2-family here and there? Is that considered an investor? Well, this is where I think each one of you should begin as an investor. Number 1, you need to be knowledgeable. You need to educate yourself. You need to know your market. A couple of things that I am certain that you're unaware of or maybe forgot, hopefully forgot. Number 1, you should be reading the Milken Report, M-I-L-K-I-N, Milken Report. Get to know markets around you. Now, if you're going to be an investor and if you're going to buy properties throughout the country, this is one report you want to know. You want to spend some time and educate yourself. Next, Bureau of Labor Statistics, BLS.gov. Why? Because that gives you unemployment data. If you're going to buy a 400-unit building, if you are looking to buy big properties, which I'm doing again, which I continue to do, these are the things that you want to be aware of, you want to know about. You want to know about a census. Why is the census important? Do you want to buy a property, a huge property in an area where there's a decline in population? Absolutely not. Some of the places, and please write this down, ALMdata.com, and I'll get back to that in a minute. Another place to gain information, Data USA, DATA USA.io. Take a look at that. You want to know the crime report. Wherever you're going to be buying, you want to know the crime report around that area. Does it make sense to buy there? You want to go on citydata.com, which is now USA.com. You want to know about sex offenders. You have a large complex. Do do you have sex offenders in your building? Now, I'm not going to say anything else regarding sex offenders, but it's your responsibility to know who's living in your property. A little bit of nuggets. Go on investopedia.com. To be more sophisticated, you should go on investorwords, WORDS.com. Now, where should I buy as an investor or a new investor? Where am I looking at? Where am I headed? A couple of things. If you want to be successful, you need to go where there are emerging markets. You need to go where business and industry are coming into that neighborhood. You need to buy where there's population growth. With that being said, I'm still lost. Where am I looking? I'll give you some of the hottest markets right now in 2020. Boise City, Idaho. McAllen, Texas. Chattanooga, Tennessee. Columbia, South Carolina. Rochester, New York. 2 more to go. Colorado Springs, Colorado. And Winston-Salem, North Carolina. Now, let's go a little bit deeper. We have landlords and we have tenants. Where are some of our landlord-friendly states? Texas, Indiana, Colorado, Arizona, Florida, Kentucky, Georgia, Mississippi. Those are our landlord-friendly states, our bigger investors. What strategy or business plan do you have in place? Again, are you a long-term buy and hold, long-term guy or gal? Or are you looking to just flip properties? I saw it before as far as primary target. Where are you? What's your primary market, secondary market, or tertiary market? Where are you headed? Are you going to be in a place like Jersey City or a smaller market like Rahway? Or are you looking to buy even smaller where there's $100,000 to $500,000 people in that neighborhood? Let's talk about the building size or the building type class. What are you looking to buy? Is it a Class A building? Do you know what's a Class A building? Or Class B building? Class C building? Or Class D building? Any idea? Class A building is a building which is 1 to 10 years old. Class B building was built 1980 and forward. A Class C building was built in 1979 or older, and a Class D building cannot be occupied at this point in time. It has to be retrofitted. Now, what do I look for when I buy property? Number one, every investor is different. One of the things that, and I'm not going to go into the nitty-gritty of formulas right now. We could certainly do that at another time. A couple of things that makes sense to me is anything that I buy, I want a minimum cap rate of 8%. And there are plenty out here. It's obviously harder to accomplish that here in Jersey City or the tri-state. It is what it is. I'm looking for a cash-on-cash return of 12%. Cash-on-cash return basically talks about the cash flow of that property. The higher the cash-on-cash return, it's a better cash flow in property. Lastly, well, not lastly, debt service coverage, DCI, I look for 1.6. Here in the US, if you're looking to refinance any property, a bank is going to look at 1.1, 1.2. I'm going in, I need a 1.6. Why? Because I have investors, I have partners, and I need to protect myself, number one, my investors and partners, number two. It's a business we're in. We're not here to buy a beautiful building that does not cash flow. Some of the other things I'm going to throw out there that you need to keep an eye on is what sort of due diligence or are you capable of underwriting such properties? Obviously, it's a lot easier if you were to buy a one family, two family, three family. It's easier to know what your income is, your expenses are, and it's easy to calculate what your profits would be. When you scale this operation and you go big, there are a couple of things I'm just going to throw your way. Should you not know it, but you need to be aware of it. Number one, you need to do some due diligence, which a lot of times you'll get what's called an OM, operating memorandum. This is a document produced by the listing agent, which gives you a little bit of history on the property, tells you where the properties or recent sales are. You want to really pay attention to what's called a T12. You want to see the last 12 months of bank statements. In case you don't realize or you don't know, people lie. Bank statements do not. So you want to make sure if I'm telling you, hey, I'm depositing every month, I'm receiving $20,000 in rents, and in reality, I'm receiving $16,000 in rents, I could lie to you. My bank statements will not. You want to verify bank statements. You want to look at rent roll. A lot of times, again, people make up rent rolls. You need to verify if it's a month-to-month tenant. You need to verify if there's a lease for 1 year. You need to know what sort of turnover is going to happen. So T12s, rent rolls, OM, operating memorandum. Now, with COVID in place, banks are a lot more skeptical or a lot more conservative in the way they will lend money. So what you need to do, also with COVID involved, keep in mind you have non-paying tenants. We just went through that, and I'm sure we may go through that again. How do you protect your investors? If you were to buy a big unit, how do you protect if your investors, if the tenants aren't paying you rents? Number one, like I'm syndicating right now, which means I'm raising money for other properties, two of which right now I'm looking at is a 92 unit in Mississippi and a 485 unit in North Carolina. So what am I doing? I basically have an SEC attorney because I'm syndicated. I'm buying property outside of New Jersey. There are laws involved. There's money involved. Things got to be done right. There's obviously a cost to do business, but spend the money, do it right. So you have an SEC attorney, which I have. I'm syndicated. I'm buying properties. Now, how do I protect my investors? Number one, with COVID in place, there's a chance that, again, we may not be getting rents at some point down the road. What you want to do is basically when you raise money, which I'm doing right now, you need to have at least 1 year what's called CapEx, which again, we could go into details at another class, but I'm just giving you a broad stroke information right now. You need at least 1 year CapEx reserve, 1 year of insurance reserve. You need to know if there are any deferred maintenance on the property as well. And the most important thing really before you buy anything, walk the property. If you're buying 100 doors, you should be entering 100 doors. You need to know what's going on in each and every unit. Because at some point in time, if you don't, and there's work to be done, the last thing that you want to do is go back to your investors and say, hey guys, I'm sorry, we need to pony up more money because we got to fix X number of doors. It's not a good situation, not a good place you want to be in. So it's work involved. You getting paid, number one, for syndicating. You getting paid because you brought investors in. Do your job. Do it right. Because if you do right by someone, they'll come back again. Again, every quarter, every one of my investors are getting paid. Everyone's making money. So that's called a waterfall, by the way. So everyone's making money when the property is either sold or refied. Again, the profits, everyone partakes in that profit as well. So you want to have at least 2 months of expenses in reserve, 1 year CapEx reserve, 1 year insurance in reserve, and the big thing with the banks right now, 1 year of mortgage payments in reserve. Now, some banks, depending on what's happening, they will give that 1 year of mortgage payments back to you in about 6 to 9 months. So your investors need to be aware of that as well. Let's talk a little bit of history. Who believes that another crash might be coming? Do you guys think one is in place or one is about to come? Let's go back in time just
I
a
think
little
one's
bit.
coming.
Huh? Hey, Stace? Yep, I'm certain of it. Let's go back. Let's look at history. Let's see what's going on. 1970. You guys remember? We had the gas shortage. We had that energy crash back in the 70s. What happened in the 80s? We had the S&L crisis, savings and loan, when nearly 1/3 of US banks failed in the US. This happened from 1986 to 1995. What happened in the 90s? We went through a recession from January 90 to March 1991. Unemployment back then was 7.8%. This was in June of 1992. 2020, April of 2020, unemployment high, 14.7%, 2020. What happened in the year 2000? We had the stock market crash. Why? Remember the dot-com bubble? 2020. What happened in 2007, 2008? We had a financial crisis meltdown. Remember Lehman Brothers? Remember mortgages, that debacle? That happened in 2007, 2008. Here we are, 2020, 12 years later. You tell me. One I'm sure is looming. Are we prepared for another one? Are you prepared for another one? Because I'm preparing for it. So as far as investing, we could forecast what's happening in the future. We actually could, based on what happened in the past. Roughly every 10 years, one have happened. 2020, one is about to happen. Now, we all know house prices are just being driven up right now. There are tons of buyers out there buying right now, which is great for us. What happens when the moratorium is over, when a lot of these tenants get evicted, a lot of these landlords lose their houses, who aren't paying rents, mortgages rather? Where are we going to be? So I think the scale might be tipping. It's just a matter of time. Hopefully I'm wrong. But that's a little bit of what I'm up to. So that is it for me, guys. Hope it was exciting. And if you have any questions, I would love to answer them for you.
Guys, do we have any
Okay.
questions for our guests?
You mentioned a particular kind of attorney. I just wanted to make sure I got it right. Is it SEC attorney who's going to go over your?
Right.
Okay.
SEC attorney.
God, thank you.
Because every property that I buy, these are bigger property, they are considered a security.
Okay.
I'm raising funds. I'm using also other people's money where I'm raising monies. I'm paying that individual who gives me money. So that's the security. Now, you definitely do not want to use a real estate attorney to do this. So there are SEC laws, SEC guidelines, there are rules for raising money. You need to know whether it's a sophisticated investor, accredited investor. There's a lot that's in play right now. A regular real estate attorney unknowingly may land you in jail.
Wow.
So you need to have the right attorney to handle this scope of business.
That was very informative. Thank you.
Yes.
And if anyone also want to participate in the big projects and the big properties, I could also assist you with that. We could certainly talk some more.
Sunil, I have a
Yes, ma'am.
question. Hi.
Hi, how are you?
Good. So, we are due for a shift and a crash, perhaps. And, considering all that, you're pretty aware of what's happened throughout history and you're a big time investor. Do you still feel like it's a good time to invest in the multifamily space anywhere in Hudson County at this moment? And if so, where?
Hudson County, I would buy smaller properties in Hudson County. Number one, there are no 50 unit, 100 units here right now that's already built unless you're going to build one. The cap rate isn't here in Hudson County or Jersey City to begin with. So you'll never make the money that you potentially could make or that you will make in a different location. You'll never make it here.
What about starting off with a condo as investment? Would that make any sense, Sunil?
Again, with a condo, number one, we got to realize that the profit on any investment is when you purchase the property, not when you sell it. So if you buy that at a good enough discount, you could factor in, obviously you have your HOA fees, you have your taxes, you have insurance, all that good stuff. But you could factor out the cost involved with along with the purchase price, you know, as far as the sale price, what the profits would be. So again, to answer your question, Karen, the profits on a condo or any smaller type unit is really based, even the bigger units, to be honest with you, is really based on the purchase price. I hope I answered your question.
Yeah.
So now I have a question for you. So suppose you have an investor who has very deep pockets. Where would you be leading them toward making an investment that A, will potentially be profitable through this upcoming crash, and B, will help protect their capital gains?
Okay. Some of the places I just mentioned, some of those landlord-friendly states is where I'm actually looking. Like I said, I'm looking at a big one in you know, in the Carolinas and in Mississippi. It's just a matter the way it must be done. Obviously, you find a property, you negotiate a deal with the seller. Oh, you know what? I just want to mention something before I continue answering your question. Whatever you purchase as well, especially with the bigger size properties, you want to try and be within 1 hour of wherever there's an airport. You want to make sure also that there's a lot of construction, you know, activities happening. I'm going to throw this out to you guys, and you can certainly Google it. You can look it up because this is certainly going to help you. Two things. Faradoon's formula, F-E-R-Y-D-O-O-N, Faradoon's formula. Look into that. You could Google it. So just look at those things, but to answer your question as far as protecting someone's money. Number one, you could blindly, you know, if I have $10 million raised today, what gives me the right to just go buy a property? Number one, I could. Number two, there's a good chance I may hurt that investor if I'm not doing my own due diligence. So how do I protect my investor? The major things, a three-step approach. Number one, I need to make sure it's an 8 cap property. It's cash flowing. I need to make sure it's a 12% cash on cash return. There's money flowing as we speak, and a 1.6 DCI. Now, everything that I'm buying, keep in mind, is mismanaged. But that's what you're going after. You're going whereby the management company is really taking advantage of the seller. So expenses are high, income low. That's the properties you want to buy. Obviously, you need to know, again, the building, class A, B, or C building, and what neighborhood are you buying in as well. So you buy mismanaged property or self-managed properties, because there's a lot of time, you know what, the owners, half of the building may be vacant or the tenants may not be paying rent. However, the other half, it's sufficient money to pay the mortgage and have the owners just live a little bit. And they're comfortable with that. I just saw something actually self-managed in Chicago at a 54 unit, which was self-managed. It happens to be though on the south side of Chicago, and I walked away from that deal. But it made sense, but I didn't want to be there, at least for right now. So You need to go into something again where there's money, there's money there. It doesn't matter, everything that I'm talking about is going to take about a 3-year turnaround. So you got to think of it and look at it as a 3-year marriage. So you and I get together for 3 years, and we know in 3 years we out. We have the ability to come back together, or we separate. Now, year number 1, let's assume we did our raise. Let's assume you were making, I don't know, $25,000, $30,000 a year. So year number 1, you make 25, 30,000. Year number 2, obviously with the rents expiring, we increase in the rents because we're making the building now more productive. We generated more income, or we may have also gotten rid of management. Year number 2, we raised the rents, so the value of the building increased. Year number 3, we do it one more time. So year number 2, you make more money quarterly. Year number 3, you make even more money quarterly. Now, after that 3rd year, if the building is either sold or refied, at that point in time, the profits from the building, you obviously get back your initial raise, your initial monies. However, the profits from the building, from either the purchase or, the sale or the refi of the building, you partake in those profits as well. So that's where you really eat like a king. So after year number 3, you get back your money, you like what happened. You have the ability to say, you know what, I love the money I made, let's do it again. So that's what it's about. Now, just so you know, going into something like this, as an investor, you have some say in what's happening versus if you were to buy a stock and they're shareholders, there's some say, there's some leeway as far as you being part owner, if you will, of that property as well. And like I said, there's going to be a lot of documents because there's SEC filing on my side. And there's a lot of protections basically in place. Protects you, the investor. Questions?
Son, does that mean that we're assuming that we're selling this building after 3 years?
Yes, but you want to every year you're making money, number 1, but in 3 years you want to make a big chunk of it. So yes.
Have you ever
Again,
done?
we do it again and again and again. So it's not a one-time thing.
If something is doing well and it's profitable, you always want to sell it just because you want that chunk of cash to do another one?
Well, again, we could certainly have that conversation, but again, when we do anything, everything's done in writing up front. So we have a game plan, we have a business plan in place, which everyone, meaning every investor, know going in what the end result is going to be, where we're going to be, where you will be. So yeah, that's mapped out from the get-go. So there's no, maybe we'll do this or maybe we'll do that. We don't want maybes. If you're giving me $1, you want to know what I'm doing with that dollar. You want to know when you're getting it back. You want to know how much that dollar is earning for you. So that's really what you want to know. And that's done up front.
Thank you.
Guys, any more questions for our guest, Mr. Sunil? Right now is the time. Ask questions. Question time. Q&A. Don't be shy.
Just had a question. When you started, did you start with smaller multifamilies or did you begin with the large buildings?
My first one was on Orient Avenue. Family.
Two family?
Family, correct. Listen, we all start small. We all crawl before we walk, right? And one of the things that I've seen, one of the things that I've learned, back in 2007, 2008, when the market crashed and everyone was afraid of, where things are heading, that very first year, I bought over 14 two families for under 80,000. Recently sold them.
So that was more of a buy and hold strategy on those properties.
Correct. But you know what? whenever there's a disaster, there's always money to be made. It's unfortunate some people may lose their shirt in it, but one of the things you also need to consider is you did not create this pandemic, this disaster, but we're here selling real estate. We're here as investors. It's either you make the money and you want to do right by people. By me saying what I'm saying also, you always want to do right by people. But if you're going to be an investor, then you need to buy the property, look at where your profits would be, and you need to analyze the deal basically before you do anything. And to certainly help you with that as well. A lot of collaboration right now between us, between our two companies, and we'd love to keep it up.
Sunil, could you speak a little bit to how one kind of gets comfortable with the idea of investing out of state? Like, so if we're looking at these, this list of landlord friendly states such as Texas, Indiana, Colorado, Florida, Georgia, Mississippi, and the hot markets are McAllen, Texas. Like, how would I go about being comfortable investing, buying a 6-unit building in McAllen, Texas?
Well, number one, if you are going to do this by yourself, you do not want to buy a 6-unit in McAllen, Texas. You want to buy maybe a 40-unit in McAllen, Texas, because or any place away from Jersey City or New Jersey. Why? Who's going to manage it? Are you going to manage a 6-unit in Texas?
No.
Or is it easier to hire a professional management company to manage a 40-unit? It's cheaper to have a management company manage a big property versus a 6-unit property.
Mm-hmm.
And keep in mind the other thing, you need to look at the figures. You need to get reports, on a weekly basis from a management company. You want to know when people are coming and going, what the expenses are. One of the things that I've seen is management companies rip people off. So you need to do your due diligence also in hiring a management company. If that 6-unit were closer to us, or if that 6-unit were right here in PA where it's, an hour and a half drive, okay, not somewhere far away.
So the takeaway there is that just hire a management company. That's how you get comfortable owning property in other states. Okay.
You need a team, number one. If you want to scale your business, you need a team. Number one, cannot do it by yourself. Or you might as well go live in that property and you'll be the janitor and every other hat that you want to wear. You got to hire someone to get it done. And you got to factor those costs also in your purchase price. One of the things that I have is basically a template, underwriting template, that basically allows me to look at my numbers. Number one, if Aaron, if you would tell me, hey, I have 100 units, would you like to buy it? You gave me your figures as far as income, expenses. I basically analyze. Number one, I'm not going to trust you because I don't know you, number one. So, or anyone, nothing against you. Never trust the buyer. Number one, you need to analyze their figures, analyze your figures. Because you making the offer, you need to make sure that, for me, I'm getting my 8%, my 1.6 and 1.6 debt coverage, and 12% cash and cash. My software allows me to see that, or to manipulate my numbers where it meets those criteria. So at that point, it tells me what I should offer you. You accept it at that, then we move forward. Then I'll move forward. I'll come take a look at the place and do my due diligence. So you're not running at the same time, traveling here, traveling there, every place that comes on the market. You underwrite it first.
Anyone else have questions for Sunil?
I have a question.
Go ahead.
So, Sunil, when you doing these investments, a lot of times they require different types of financing. So when you get those financing, do you require low income housing tax credit when you get it, when you do yours, or do you just go with straight rent rolls and things of that nature?
Straight rent rolls.
Yeah.
I go into the rent rolls.
Right, because there's other additional things that you can do, in depending on how big the unit is. I was just wondering if you utilize some of those government breaks that they may allow you to get. You can do like a 80-20, a 40, 60-40 and stuff like that in reference to regular income and moderate income and low income.
If I'm answering your question, are you referring to structuring the deal in order to take this project down? Is that what you're asking?
Yes, absolutely.
Okay. What I would do, or what I'm doing, basically, I'm putting in place my closing costs. I'm raising money towards the closing cost, towards my down payments, towards reserves, because when I go meet with the bank, number one isn't going to lend me 100%.
Right.
Today, you're looking at about 70% is what they lend. So I need to raise, number one, about 30%. So time to time, you want to probably raise about 33%. That's where you want to be. Because listen, sometimes you may have let's say you speak to 100 different individuals. Let's say 50 say, yes, I'm ready. Now you bring the deal to the table, you go back to those 50, or to that 50, you may find some of them say, no, I'm not ready to do anything, or I've just bought something. So that changes. So you always want to have people in place or investors in place. But to really answer your question, the raise you're looking at is about 33%.
Okay. Because, with that type of investing, there are some offsets that you can use. I was just wondering if you were utilizing those at all when you do it, but I guess not. Okay, thank you.
Welcome.
Son, can you explain why not?
I've always done it this way. I've not looked. It's more straightforward right now too with COVID. The banks are just being very not skeptical, but their underwriting guidelines themselves have changed. So you just need to have the monies in place. Because a lot of times too, they will say, well, you need to have X more dollars for certain things. And it's just easier just having the money in place.
Do you do a lot of 1039 exchanges?
1031.
Yeah, I always call it the wrong number every time. 1031.
I haven't, to be honest with you.
Sunil, do you use hard money, or how do you raise that money?
This is just regular people who may have money and who really have no idea what to do with their money, but they're looking for a great return on their investment. So if I were to use hard money, I'll get killed. Because hard money, number one, you got to repay that in a year. You got points and interest. If I were to borrow a couple $1 million from a hard money lender, number one, my numbers to meet my trifecta is going to be skewed because now I'm factoring points and higher interest payment to investors. It's not going to work. You could use a hard money loan, if you want to do like a smaller 2-family, 3-family. It's never going to work with a hard money lender. Unless it's going to be like maybe a JV deal where or he or she knows exactly what they're making and it's amicable and you could make money as well, because at the end of the day, you're going to be doing all the work. That individual or that investor, whether someone gave me $100,000 or $1 million, you wouldn't be doing anything. I'm the one doing everything. So if I'm doing everything, number one, I'm finding the deal, I'm analyzing the deal, I'm going to the property, I'm turning things around, and I'm putting money in your pocket. What is that worth also to me? I'm guaranteeing you, and I'm making sure you get your money. So what is it also to me? I need to also make money. and it's out of state, so it's my travel expense also.
Thank you.
Welcome.
So Neil, what's been the strangest thing you've ever found in doing your door checks?
Just, you know, looking at location really is where you want to be, especially now. Just got to be a little bit more cautious. Just it boils down to location. You want to sort of gauge where industry is going. A lot of places, a lot of businesses right now are closing up or moving. Just do due diligence. You know, it's going to take you a couple hours to do it. You just got to get it done. So this, you know, on the biggest scope and the biggest scale of things, it's time consuming. You spend a great amount of time because, again, you need to do it right. You have one shot at doing it right. Screw it up and that's it. Investors lose all confidence in you and it's over.
Do you have a kind of a sweet spot when it comes to a number of investors that you work with? Does it matter?
It really doesn't. It just depends on, you know, having a good relationship with that investor. You know, do you want to have an investor where every single day you get that phone call? So what's happening? What's happening? What's happening? You know what? No. It depends on the raise. It depends how much money the raise entails. Listen, if you could have one or two investors doing the entire raise, it's a lot easier because every quarter now you have distributions every quarter. Number one, you have information that financial information that has to go out every quarter as well. So if I were to have 100 investors, it's really a lot more work. If I had a handful of investors, it's just easier to do what I need to do. At the end of the day, it's work. And you want to have a good fit also. You want to have people who, number one, is not going to be on your behind every single step of the way. And that's the reason why there's a SEC attorney also involved and a bunch of paperwork, and you want to do it right. You want to put your head on your pillow and don't worry about what the hell is Sunil doing, you know? Is he taking my money and go buy a car? Or what is he doing? No one needs that. I don't need that. That's not what this is about.
So what I'm sort of taking away from this, Sunil, is that so you started with a 1-2 family, and that that was sort of how you got your toe in the water, and then that experience led to a series of larger. How many years were you doing this until you kind of got comfortable investing other people's money and not yours?
At least, you know what's the funny thing? Even in doing the smaller properties, I actually never used my own money. I've never, as God is my witness, I've never used my own money to buy a property. Never. Always, one of the things I believe, OPM, other people's money. That other person makes money, I make money. And they're happy with their return as well. Obviously, you do the right thing and they come back, OPM. Started small. We all got to start someplace. Start small, and then you just want to scale your operation. It's been at least 10, 15 years of, just the smaller stuff. And you want to learn. You want to be able to deal with tenants. You want to have nasty tenants in your face sometimes. You want to go to court. You want to be able to file the evictions. You want to toughen up. You have to toughen up. And because you know what, we're all pleasant, we're all nice, and when you start dealing sometimes with people who aren't nice, it makes you stronger, it makes you tougher, and we need to grow also. So this is one way where, you know what, school of hard knocks. You learn as you go along. I've made my share of mistakes as well, believe you me. You learn, you get to a point where you get better at what you do. But again, you start someplace. Should you just go out there and buy a 400-unit building? Probably not. He never bought anything. Start small. You soak your feet in the water, and you take it from there.
Sounds a lot like the 10,000 hours required to get mastery in anything.
Yep, that is true.
Mr. Sunil, I have a question. I know you mentioned previously, and I'm sorry, I've just been doing a million things here. I kind of caught it in passing, but you mentioned property management and how it's better to have a company rather than an individual. What are some of the pros and cons of working with a property management company, and what are some of the cons of working with an individual as a property manager? Excuse me.
Okay. My question to you: if you bought a 20-unit building,
Yes, sir.
and in one of those apartments, let's say your cousin lived in one of those apartments, and he's a handyman. Do you want him to go do everything in the building, or number one, is he really capable of doing everything in the building? Are you going to be keeping that relationship civil, or are you at some point, is it going to get contentious? Are you going to fight? Are you going to fire that person?
Okay, I see.
The second is, if it was you, if you think, you know what, listen, it's my building, I'll handle it. You're welcome to do that too. When the calls come in, 2 o'clock in the morning, when the pipes break, if you got to go there just to flip a switch, because there's stupid things that happens, are you going to run and do that every single time?
That makes sense. Yes.
So what you want to do, where's your time valuable? Where do you make your money? Where's it better spent? So that's why when you underwrite one of these type deals, you factor that management cost in the deal. So you make sure, number one, it is still cash flowing and you're able to pay for management. I don't want to get a calls. I don't want to hear the stupid nonsense that goes on. I'm paying you to handle the problems. So handle the problems. So my job should be focus on getting me another building and hiring someone else.
Right.
Or meaning a different property manager, or if you're big enough, have your company. If I'm good with you, have your company manage another building.
Got it. Thank you so much.
Any other questions, comments, observations, ahas from this incredible hour that we've gotten to pick Sunil Chillar's brain about big thinking in the world of investment property?
One of the things I'll just mention, while I guess a question should come, we hear selling everyone real estate. We hear making a commission. Are we planning to spend the rest of our lives making a commission and watch everyone else own the buildings, make the big bucks? How long do we all continue or would like to continue doing what we do? Just make a commission. Are you going to retire making a commission? We have a 401k in this industry. I don't think so.
Nope.
So you know what? If you haven't started investing, it's the time. Now is the time. Whatever you do now, you got to think in the next 20 years, it's going to come. 20 years is going to come. What happens then? So whatever decisions you make now is going to affect 20 years from today. So you got to start doing something for yourself today.
Son, what do you think about what's going to be happening in New York City with the mass exodus? And I think also businesses may be making an exodus. I see opportunities, but I'm just curious what you think about that.
Well, right now, like anything else, and I'll refer it also to Jersey City. Right now, yes, there's a mass exodus from New York City. But at some point in time, when COVID goes away as well, don't know when, but when things sort of get back to whatever normal is going to be, people are going to move back in. It's just people are, what's the right word? People tend to forget.
I was going to say resilient.
No,
I was going to say have a short attention span.
I would look at like right here, right in our backyard in Greenville. People for the longest moving out of Greenville, didn't like Greenville. When, for 20 years I'm in Greenville. It's my stomping ground. When everybody is talking, don't buy here, I don't want to be here. I'm here. You know what? I've always made money in Greenville. Just like New York City. Some people are moving out, not everybody. So it's going to come back. Like anything else, it's just a wave. It's just a cycle right now. It's going to rebound. Look at when the planes crashed, 9/11. Everyone's talking, hey, I don't want to live in a tall building. What changed? People in tall buildings again. I forget. So it's here, it's now, it's brief. That's going to change. The fact that, hey, we got a house, we got a backyard, we got space, I love it. But, there are some who wants to be in a condo, who wants to be in an apartment and don't want to fix anything, don't want to deal with anything. You're going to move in there. So it's short-lived, it's short-term.
Good perspective. I appreciate that, Sunil. Well, all right. I think we have, unless anyone else has any more questions, we'll bring this train into the station. And I want to say,